Cathie Wood's ARK ETFs, which saw record inflows earlier this year, are getting whacked with the broader tech weakness. All 5 of ARK Invest's actively managed ETFs are now negative for 2021. Joining us now for a first on CNBC interview is ARK Invest CEO Cathie Wood. Cathie, welcome back to the show. Good to have you.
Great to be here, Sarah. Thank you.
It's been amazing to watch your rise and your funds rise over the last year, and yet the past few weeks have been absolutely brutal. The ARK Innovation ETF down 31% from the recent highs. How concerned are you about these rising interest rates and what that's doing to a lot of your high growth companies and the questions about valuations?
Sure. Well, we've been struck that the market never priced in 0.5, 1, or 1.5% interest rates. We think the market never believed interest rates would stay down here. And so it over time, we believe, has used sort of a normalized 3 to 5%. So we don't think that is why the market is correcting here. We do think the speed of the increase in interest rates is scaring people. It became very comfortable in a low interest rate environment.
That's what I said. It's the rate of change.
To become involved with the market. And I think this has shaken a lot of investors up, maybe perhaps. And I would say even in the bond market in particular, we've been in a 40-year bull market in bonds. So I think there's a lot of confusion, and I think there's a little bit of paralysis here. I also think that there is a very rapid rotation now into value stocks. We've seen energy up year to date 39%, financials up about 16%. Those are traditional value sectors. And so I think that's been part of the reason for ARK's setback. But if I could add a little perspective to this, this happened to us in the fourth quarter of 2016 as well. Right after President Trump was elected, the stock market took off because tax rates were going to go down and so forth. And so the market started pricing in a very strong cycle, which was correct. In that period of time, our strategies went negative. And what I said at the time and what I believe now is that the bull market was broadening out to incorporate value or more cyclical sectors. And I thought that was going to be very good news for our strategy longer run. The worst thing that could have happened to us was another tech and telecom type bubble where the market narrowed so that only a few groups won. Right now, the market is broadening out, and we think in an underlying sense, the bull market is strengthening, and that will play to our benefit over the longer term.
She said that
How about
last week.
Tesla specifically, which is now off 37% from the recent highs, is down another more than 5% today. Everyone wants to know what your new price target is, Cathie, because the last time you gave that price target, it seemed crazy to a lot of people, and then not so much when Tesla actually rocketed 700%. So where are you now on where that stock goes?
Well, we're about to publish, I'm hoping it's within a week or two, our new forecasts. Our confidence in Tesla has gone up for a number of reasons. One, it didn't lose share of the electric vehicle market when all of the traditional luxury brand names started bringing their own electric vehicles to market. Now, we expect it will lose share, but our expectation was that its share would go from 17% at the end of 2018 down to 11% as more electric vehicles were coming out. Instead, what happened? Its share moved up to more than 20% and roughly 80% in the US market, 80% of electric vehicles. So that's the first source of confidence, market share up, not down. The second is autonomous. We believe that Elon Musk, who over the weekend tweeted out that he would offer, or Tesla would offer, full service driving to anyone who wanted it, saw an incredible burst in demand. So for him to be able to do that suggests to us that he's going to be able to show us the way to autonomous much faster than most analysts and investors expect. So our the probability we have put on Tesla really winning the lion's share of the autonomous taxi network market in the United States also has gone up. So you might imagine the price targets have gone up considerably.
I have a broader question on Tesla in a moment, Cathie, but quickly first, on self-driving technology, are you saying all of the revelations and news from the company in the last couple of weeks has only improved your outlook on the company? Because some analysts, based on the response to a Freedom of Information request, were underwhelmed by the outlining that they're more like level 2 in terms of that technology than perhaps some expected the announcement to be.
Well, we believe that Tesla has been doing this differently, staging the movement into autonomous differently from other companies like Waymo and Cruise Automation. And so I can understand why there's some confusion. We think that their strategy is not market by market ultimately, but national. And so I think there's a misunderstanding about how they're going to market.
My broad question on Tesla, Cathie, and you have been so right on this company and so many other companies that you know, I sit here and think, who am I to even bother asking this question? But I think it is fair to compare things today to Amazon, to people who were right to be bullish on Amazon as it pulled back in 1999 for a couple of years because of where it is now. But it did take almost a decade for it to get back above its pre-pullback 99 peak. During a period of time when it continued to take market share, continued to grow revenues, continued to grow profit, but there was a 9-year period where the share price was underwater. Is that not possible to apply to Tesla going here, even if you're absolutely right that the company's top and bottom lines continue to grow, continue to take share?
Well, I know the Amazon story well because I was living, eating, and breathing it the entire time. So what we saw in the tech and telecom bust was the recognition that we were not ready for prime time for a lot of the companies evolving at that time. And so there were a wave of bankruptcies and the psychology became, well, many people thought that the internet was a figment of Wall Street's imagination and that no one would make any money off of it, and Amazon included. And the time period you're talking about, Wilfred, was when Amazon basically was saying, look, we will be as close to cash flow neutral as possible, but we are going to turn every revenue dollar we possibly can back into investing. That's how they won. But they did not show profitability, not any substantial profitability, but often losses for many, many years. They just believed that if they invested aggressively at that time, that they would win the lion's share of the online retail market. And that was absolutely right. I think Tesla has already passed through that phase of its life. It did invest aggressively, and it has on four metrics. It is leading the charge, so to speak. So battery technology costs lower than anyone else's out there and will remain lower. Artificial intelligence chip, it designed its own. No one else has designed its own chip. This is analogous to Apple in the day. Cellular companies, Nokia, Ericsson, and Motorola, didn't see the future. Apple did, and yet it couldn't get Qualcomm or Intel to move quickly enough. It had to design its own chip. And of course, now Apple basically accounts for the lion's share of all the profits from smartphones in the world. We think this is going to happen also with Tesla. Maybe not worldwide, because we know China wants its own champion. But that AI chip that Tesla designed, our analyst said, was 4 years ahead of where NVIDIA was at the time, and this was a couple of years ago. They have more data collected than any other company by orders of magnitude, not just by any other company, but by all other companies out there, because the largest pool of data with the highest quality is going to win in the AI game. They have the largest pool of data. And finally, until very recently, Tesla was the only automobile manufacturer able to improve performance of its cars with over-the-air software updates. I got my Model 3 in 2018. never had a problem except a nail in the wheel, which they couldn't correct over the air, of course.
Tesla's fault.
Never a problem. So what they've done is extraordinary, and I think this is their market to lose. I think they're in a very, very different place also. We're not in the tech and telecom bust. We are 20 years later. All of the seeds for what is happening now were planted back then. Now they're coming to fruition.
Autonomy should have known that.
Tesla off the session lows, down 4.8%. Cathie, if you would, stay with us because we're going to take a quick break, and we have a lot to hit to when we come back, including crypto. I know you're a fan, and some of your other holdings we saw right there on the wall, like Palantir and Square. Stay with us here on Closing Bell.
We schlot. Okay, so let's while they go on a quick little break here, let's do a little summary as to what was just said here. So, first thing I want to touch on is the really what's causing this. This is something that, look, a lot of people identify trends in a marketplace, and we were actually just talking about this over here in the private course member live chat. Which obviously, if you haven't joined yet, make sure to check out that coupon code down below and get yourself that 38% off. Look at that, we got a nice little banner here. You can go down below. It expires on March 15th. Why not? Okay, so I need lifetime access too, which is great. But anyway, Cathie Wood identifies the same thing that we've talked about on this channel before, very early on, that the risk here has been the velocity, or the acceleration, rather, of rates going up, and now how rates are really consistently sitting up. So it's kind of like that rush up, that sort of boop, and then now that we're sitting there, is really potentially driving some of the anxiety here. I personally think that may have started this anxiety, but I actually think that the rotation into recovery stocks is actually really taking the lead right now. So it's kind of like if there are two drivers in a car, one is, both of them are sitting here. This is the recovery driver, this is the rates driver. I think the rates driver hit the gas really hard, really fast, like floored it, and we took off. Like that caused a big shock to the market. Now, the rates driver is kind of taking the foot off the gas a little bit, and at the same time, the recovery driver is kind of putting the foot on the gas a little bit. So it's kind of like you got these people in charge, and tech is just in the back going, oh, that's kind of the way the market feels right now. Personally, I think it's just going to be a matter of time before society realizes that recovery and rates are stupid drivers of the stock market, and the tech driver will come back in the market. Going along with this analogy here, where tech will circle back, and the tech will include the end phase and the electric vehicle stocks, all of which are selling off to great discounts today. I mean, if you were somebody who was new to the stock market right now, let's say you had even if you got money in your portfolio and you're down right now to November lows, certainly you're not down to like the summer of last year's lows. Try to forget for a moment the rest of your portfolio, as hard as it is to do, and ask yourself, okay, cool. Hey, if I'm getting paid on Friday, would I buy stocks at today's levels? And when you look at stocks today, it's like, man, Tesla 566, NEO 35. Yeah, I'd consider buying some of that, right? In my opinion, that's what I'm looking at. Now, do I want to buy Cheesecake Factory where it is now? Less inclined to do that. I certainly see way more of a run potential in NEO now than in Cheesecake Factory now. So personally, I think this rotation into value or recovery is getting a little overdone. One of the downsides of this that Cathie hasn't brought up yet is the potential for value traps, but she is back on, so we'll circle back.
Sticking around, I wanted to ask about Bitcoin, a big picture question over the next decade. Do you think it will prove to continue to be correlated with risk assets, or will it emerge to be negatively correlated in a way that you could argue gold perhaps has been over the long term, or the dollar has been in terms of its correlation with stocks?
What's been interesting about the correlations, Bitcoin to any other asset class, is the correlations have actually been very, very low over time. In fact, the highest correlation is between Bitcoin and real estate. Now, the IRS taxes Bitcoin as property, but I don't think that's the reason for this correlation. It just so happens it's that. So we think that as it becomes a better accepted new asset class, and we are seeing institutional movement into the space, and we're seeing the diversification of balance sheets from cash into Bitcoin, we do think it will behave. Actually, I would say more like the fixed income markets, believe it or not. If you think about bonds from this level, this idea of a 60-40 balanced portfolio is a bit problematic. We've been through a 40-year bull market in bonds. We would not be surprised to see this new asset class become a part of those percentages, maybe 60 equity, 20, 20. So I actually think that might be the biggest surprise here.
I wanted to ask about fintech as well. I know you're a big believer there. And I wondered whether you look at the incumbent financial companies and banks in a different light than perhaps you do the incumbent autos compared to Tesla, or the incumbent retailers compared to Amazon 10 or 20 years ago. Are any of the traditional banks, with all the investment they're putting into tech, whether it's Goldman with Marcus, Citi with their partnership with Google, or the investments the big banks have made into Zelle, whether any of those banks are investable as plays on fintech, or are they all going to get crushed like certain retailers and autos have been?
Well, it's interesting that you say that. We have often expressed a point of view that there's old DNA and new DNA. It's when the technology platforms shift, it's very hard for DNA to shift from old to new. That said, you've seen with Walmart, you're going to have a Walmart, a Target, a Costco. So you'll have maybe 2 or 3 mega banks. And yes, a lot of them are investing aggressively now, which is what they should be doing. But we do believe that the 2 of the biggest sectors that will be disrupted in the world today are the 2 that have been best performing this year: energy and financial services. So choose wisely and make sure you're on the right side of change. Make sure these companies are investing enough, have invested enough. So many companies simply leveraged up to buy back shares, and now they're facing this huge investment mandate. So make sure that you invest in those that will be the survivors. And we do think that the carnage is going to be pretty significant in both the energy and the financial services sector long term. Now, in a V-shaped recovery, and we think we're in a very strong recovery right now, they're going to do fine. They're going to do fine. And in fact, the yield curve is very wide by recent standards. So that should accrue to the benefit of financial services broadly. So we're not saying that this is a fake out short term, but we are saying long term, watch out.
Yeah.
Cathie, just back to your fund's performance just recently and what we've been seeing. How are you navigating these heavy first inflows and now outflows? And
Yes.
my other question sort of related to that is why are you selling liquid stocks for illiquid stocks in a downturn?
Well, it's part of our strategy. So in the coronavirus, we concentrated our portfolio towards our highest conviction names. So the flagship portfolio got down to 33 names. As the bull market extended, we added names. It's up to 55 names. Many of those names were much more liquid stocks. And so you're right, Sarah. When we get opportunities like this, to invest in pure plays instead of more mature plays, still innovation, but more mature and not as pure play, we will move back into pure play. Those are the more volatile names, of course. And so we're getting great opportunities. And just to give you a sense of that, our minimum hurdle rate of return for any stock to enter our portfolio is 15% over a 5-year period. So that's a doubling over 5 years. Now consider the source, but given the very sharp pullback we have had here recently, nothing's changed from our point of view on our long-term projections. So the only thing that's changed is the rate of return. So a 25% rate of return over 5 years. So we're becoming more and more optimistic about our portfolios in this sell-off.
We could go through a number of stocks that you like and that are all high interest on the street, from Palantir to Square. Why don't you give us, besides Tesla, which we know you're a big fan of and your conviction has increased there, which one you think is the most underappreciated name right now in your portfolio that you'd be looking to add positions to?
Well, we just went through this morning. Invitae in the molecular diagnostic space is probably one of the most important companies in the genomic revolution, and it is getting hammered. It's a company that has had historically small cash cushions, although they've rectified that with offerings, which is great. But it's investing aggressively to be the leader in the molecular diagnostic testing space. Many people, the disconnect for many people here is when they think
That one statement just led the stock up like 7%.
Corp and Quest Diagnostics, which are effectively very mature companies, commoditized value stocks. And so it is a little bit like Tesla in the automobile industry. The new lab tests, which are going to be informed by artificial intelligence and big data and supercomputing power, are, we believe, in a winner-take-most market as we move into personalized medicine, much different from one test for all, although we'll see multi-cancer screening certainly in that realm. But we think the move towards personalized testing is going to give just a few companies the lion's share of the market. Those companies with the most data, the highest quality data, and the best AI expertise.
Cathie, great to see you. Thanks so much for joining us today.
Thank you. Thank you, Wilfred and Sarah, very much.
We've only got 9 minutes left of the session.
Yeah, we do. Okay, so let's break down a little bit more about what she said here. So she did end up bringing up the value stock portion. By the way, she is going to Bloomberg in about 70 minutes. She'll be on Bloomberg, and we'll watch that as well. Look, she did go into value traps after the talk here, or after the commercial break that we had. One of the things to keep in mind about value traps, she's not, I feel like she's not purposefully not being like super blunt, but basically what she's saying is, hey y'all, you gotta be real careful about buying the crap that people are buying right now just because it's going up, because these are companies that are buying back their shares and spending money, wasting money on dividends rather than investing into transitioning into the future. Maybe they'll create a future committee and invest in the future She's obviously very, very frustrated, but she's expressing it in a very logical way. This has become a benefit for her, though. What she just mentioned, this bomb that she just dropped, I think flew by a lot of us. And I want to really highlight this one right here. So her thing is, over 5 years, usually she wants to see a 2x. Over 5 years, she wants to see the portfolio 2x. That's a 15% compounded annual rate of return. She just said, at today's prices, we are revising that to 25% compounded annual rate of return. That is 3x. Cathie Wood is now saying, at these prices, I expect stocks to 3x. So while everybody's running over to cheesecake and all this other crap, I'm saying that in her paraphrasing, right? I'm really overly paraphrasing here. But while people are running over to this other stuff, they're creating an opportunity that now means we're expecting a 3x return on people who are basically buying these stocks today. Pretty powerful. I did also, by the way, I sent a tweet to her just about 2 minutes ago. So if you can, go to @RealMeatKevin on Twitter and retweet. I would love to have your support, mostly because I would love for us to be able, as a community here, to get Cathie on this channel. So your help in making this happen would be really cool. I don't think she will block me for this, but no, I would love to see Cathie on here, because I want to ask her about the difference of opinion we have regarding the Fed. What if she's wrong? What if the Fed isn't going to jack rates sooner than expected? Of course, then we'll also have to talk about what if she's right. We'll also have to talk about some of her individual stock picks. What do we think about Square's relatively stretchy valuation compared to something that feels relatively inexpensive compared to Tesla? Now, she does have more of a Tesla position than Square, but we want to be able to ask about these particular things so we can identify in our portfolio. Why a certain stock pick over another? Obviously, if we were to get Cathie on, I'll also put a Q&A section in the private stock group where we can where I can ask you anytime I do an interview, where I will certainly from now on. And I've done this more sporadically, but I need to be more consistent about it. I like to have a little channel where it's just like, oh, ask questions for this guest coming up, and it's a great way to interact there. So @RealMeatKevin on Twitter, would love to see your support for this. No paper hands. No paper hands. No, Cathie's killing it. I'm in big support of what she's doing. So let's go. Let's look at the sticks here. So we've actually got a little bit of a pump here. Oh wait, hold on. We got to keep going with one more thing that Cathie mentioned. So one more thing about Cathie Wood is she really went deep on Tesla. She talked about how phenomenal it is that Tesla is really going to be allowing people to manually download the beta for full self-driving. And honestly, she's right. That is a huge catalyst. Now, people are upset that there were some FOIA requests, Freedom of Information Act requests, that where basically Tesla says, look, we're telling regulatory agencies this is level 2 technology, which means it's not really full self-driving, right? Personally, I think Tesla's doing that because they're saying it's a beta. We're still requiring people to hold the wheel. So it could be level 3, but it's basically level 3 with an asterisk where Tesla's telling the government, we're still telling people to hold on to the steering wheel. I don't see that as much of an issue. I mean, Green was tweeting about this yesterday. I was reading these threads. You know, he's somebody who likes to hack into the code behind Tesla's work and does a great job. I don't think any of that is an issue. I actually am in heavy support of, rather than this like, oh, let's just have 1,000 people or maybe 2,000 or 3,000 people doing the self-driving beta. This is a huge inflection point for Tesla when that full self-driving beta comes out, because it basically means, I mean, look, the older self-driving stuff, this stuff was basically a beta anyway. I mean, not really, but I mean, there are some cases, like you can't fully trust the self-driving yet. It's basically still level 2 beta-ish, you know, and I'm obviously oversimplifying here. But being a Tesla driver, look, I trust it a lot on the freeway, but I can't trust the thing everywhere. And you start getting used to where you can trust it and not. But Cathie's right. That is going to be an underappreciated facet of Tesla valuation until it actually becomes appreciated. I honestly think most Tesla analysts are not including the true disruptive potential full self-driving. In fact, I responded to a tweet earlier today as somebody was showing off Chevy Cruze's Cadillac, self-driving, and I almost wanted to vomit. I mean, the thing is like 3 years behind Tesla. I remember dealing with the problems it had to deal with 3 years ago. It's shocking. Anyway, so projections have changed going from, okay, and the other thing that she's doing is she's concentrating into her higher conviction stocks. This is what I'm doing with new money. I sold before the crash. I sold around, 1 to 1.5 million. I sent out buy alerts to everyone in the stock group, which, remember, use that coupon below and get your 38% off, expiring in about 7 days. But anyway, yeah, that was, in my opinion, the time to shave down my lower conviction stocks. That's around the same time I sold Microvision, for example, and some of these other ones. And that gave me some more of an opportunity to really go shopping over the last few weeks here. So, okay, that's the part on Cathie Wood.